Do you want your business to grow faster? Are you open to new and out-of-the-box ways to drive revenues and increase value? How do you imagine the most successful entrepreneurs and business leaders double, triple, or expand their businesses tenfold or more? The answer is deals. This is a weekly podcast featuring conversations with business owners, executives, and leaders as we reveal behind-the-scenes details that give you, our listeners, the confidence to pursue your own deal-driven growth. On the show, we discuss a huge variety of deals, everything from large, complex mergers and acquisitions to smaller deals that you can do even without significant capital. My name is Corey Kupfer, and I've been supporting deal-driven growth for businesses for 35 years as a successful entrepreneur, professional negotiator, and attorney. My goal is to help you strategize, plan for, find, and complete deals that will help your company grow faster. Welcome to the Deal Quest podcast. Let's get started. John Warrillow is the founder of the Value Builder System, host of Built to Sell Radio, and author of best-selling books, Built to Sell, Creating a Business That Can Thrive Without You, The Automatic Customer, Creating a Subscription Business in Any Industry, and The Art of Selling Your Business, Winning Strategies and Secret Hacks for Exiting on Top. He also has personal experience in selling a business that he was told was unsellable. So I'm really interested in hearing that. And he's interviewed over 300 founders and entrepreneurs on preparing to exit their business. So listeners, you and viewers, you clearly have no doubt on why I'm having, and I've been wanting to have John Warrillow on the podcast. John, welcome to the show.
Hey, thanks for having me, Corey.
Awesome. So listen, before we get into all that great stuff and all the great work you do with clients and the personal journey and stories, I want to take you back to when you were a little kid, maybe 8, 10, 12 years old. What did you want to be growing up? Because my guess is, somebody who sold companies and writes books and has a radio and works with all these folks might not have been it at that age, but you tell me.
I wanted to be Mike Wallace. Do you remember Mike Wallace from 60 Minutes? I used to love it when he would go to like the car mechanics that had been rolling back the odometers and, put them on the spot and stick the microphone in their face and say, what have you done? And I love that. I love that show. To this day, gosh, 30 years, 40 years later, I still watch 60 Minutes, even though the whole crew has changed and they're all different. But if I wasn't doing what I'm doing now, I'd probably be I'd want to be a 60 Minutes host. I'm not sure if they'd take me, but that's probably what I'd be doing.
That investigative journalism kind of thing. Yeah. Huh? I love it. Yeah. Well, listen, you do interview people, right? So there's, there's at least a little bit of a through line there. One more question looking back, and this could be, something small you did as a kid or early in your career. What's the first deal that of any type that you remember doing?
Oh gosh, I was Johnny the Juice Man in grade 6. So Johnny the Juice Man was my nickname because I sold juice in grade 6 cafeteria, in the grade 6 cafeteria. And I got the job because the guy who sold the juice got to leave class early to get the little counter set up at lunchtime. Okay. So I got to get out of class 15 minutes early to get the juice stands set up. So I was Johnny the Juice Man. That was probably my first deal.
That's it. That's your first deal and your first personal branding, huh?
Exactly.
and that was before personal branding became a thing, right?
Oh yeah.
Especially internet wise. I love it.
Well before.
So we gave a bit about your bio, but give us just a little bit. Like, how did you go from Johnny the Juice Man to being the guy in terms of talking about how people prepare to exit and build enterprise value and selling your own company. Give us a little bit of the journey so people have a little more history.
Yeah, a bit of a circuitous journey. I'll keep it short. I've been involved in building a few service businesses. One in particular was a quantitative market research business. I went to see a business broker to see if he could sell it. And it was a business that was, it was a great business. We had big clients. Microsoft was a client, JP Morgan Chase, Bank of America. Yep. So I thought I was sitting on a gold mine. We had about 5 or 6 million in revenue. We, 20, 30% profit margins. So I thought, man, this is going to go, this is going to go for a huge price. And I went to talk to this M&A guy in Toronto. His name is Perry Miele. I'll never forget. He sat me down in his office. I said, what do you think it's worth? And I was rubbing my hands together, waiting for the answer. And he kind of peered to me over his glasses and he said, well, all right, well, let me ask you a couple of questions. And I'm like, shoot. He's like, you're in the research business, right? And I'm like, yep. He said, all right, well, who does the research? And I'm like, well, I'm just like, Bank of America. Like I've got to, be involved. I certainly approve. And all right, well, who does the selling? I'm like, it's Perry. It's these big clients that, they need me to go to the meetings. Like I got to be the front guy. And he said, let me get this straight. You're in the research business. You do the research and you do the selling. And I'm like, I guess when you put it that way, yeah. And he said, well, John, I can't sell your business. It's worthless.
Yeah.
And I remember to this day, I mean, this goes back, Corey, a long time ago, 20 years ago, excuse me. I can remember that conversation and feeling like an inch tall. And I went in there feeling 8 feet tall, right? Like I went in thinking I was sitting on this gold mine. And I left his office realizing that I'd made every mistake in the book, that the business was too dependent on me. And anyways, long story short, I took that cold shower and hard medicine. We made a bunch of changes to the company. Perry was a great advisor along the way. We put in a subscription model. We hired salespeople. We stopped getting out of custom, and we built it up to a kind of a smaller version of a Gartner Group. And we ultimately sold to the company that you now know as Gartner Group, big New York Stock Exchange listed company. And that would never have happened had we not really did a 180-degree change on what we were doing, how we were approaching it. So it's got a happy ending, but it was a difficult time. And that's probably what got me into helping other entrepreneurs think through, how they might exit their company, what the value of their business might be, how it could be improved, et cetera.
Yeah. So John, so you mentioned, a couple of the key elements, obviously making the business less dependent upon you. And that's something that in the entrepreneurial circles you hear about a lot. I've been a member of Entrepreneurs Organization for, a long time. And around EO, I was president of the New York chapter. I, even when I travel internationally, like it's the whole thing, right? Michael Gerber, E-Myth, all of this stuff, right? Have the business, be less dependent upon you. That's not a new concept, at least in the entrepreneurial circles. But the truth is most people don't really manage to get that done. You'd also talked about, which I want to hold aside, but I want to put a footnote here on subscription models, right? The whole conversation, recurring revenue and how that improves stuff. So, but before we go to that, I'm always interested in mindset shift, right? Because I'm a big believer that there's a mindset, mindset of a deal maker, there's a mindset of an entrepreneur, there's a mindset of a deal maker, which is different than the mindset of an entrepreneur. And as a leader entrepreneur, we can understand intellectually these concepts, but nothing's going to change unless we really shift our mindset around it, right? So before we talk about how you work with other people on that, what happened in your mindset? I mean, obviously, it sounds like this conversation you shared was a challenge, right? And triggered this need to, but like, what was that process of like shifting the mindset of how you built your business and how proud of you were to having it become less dependent on you? Like, what did that really take?
Yeah, I think it took an appreciation of the way as entrepreneurs we celebrate success and why that's so hollow. So if you think about the way entrepreneurs are taught to recognize one another, we quickly at a cocktail party start asking how many employees you have. And why do we do that? It's because it's a proxy for how successful you are. Yeah. If you employ lots of people, our assumption is you are successful. I think that's completely wrong-headed. I also think it's wrong-headed to celebrate the top line revenue growth of the company. So if you think about the Inc. 500, now the Inc. 5000, there are tons of unprofitable companies. There are thousands of businesses that have given up all of their equity. They're minority shareholders in companies, but it's because they are so determined to be recognized for their growth rate. And there's an old expression that revenue is vanity. And I think for me, I realized I was chasing the wrong stuff. I was chasing the vanity metrics, which are revenue, number of employees, Inc. 5000. In Canada, it's called the Profit 100. It's long since gone away, but we we celebrate these things as if they are what is to be celebrated. And to me, we need to take a step back and say, actually, if revenue comes at the expense of the value of your company, it's actually undesirable. If your growth comes at the expense of having to share equity, give it away, give all your decision-making authority away to VC, it's actually undesirable, or something you should at least think very deeply about before you do. And so what I would encourage, and what I started to do, mindset shift, Corey, is I started to think of myself differently. And this interestingly kind of corresponded with the time I became a parent. And I realized quickly that and you know this, as soon as you become a parent, like you realize, oh my gosh, like it's not all about me anymore. Now I have to think about other people. And so I started to think about my company in a different light. And that was that I was the parent of my company. And again, I don't know about you, but when I think about my aspiration for my kids, like, I don't care if they go to Harvard or they're the captain of the football team. Like, my goal is that once they're done in the house, and we've got one leaving soon, so I'm hypersensitive to this right now, that they can go out into the world and succeed on their own terms, be independent without me. And so my whole job as a dad has been I happen to have two boys. So how do I get these guys out of the house and to be able to kind of stand on their own 2 feet independently? And so I started thinking about my company in the same way. I said, like, the ultimate goal here is not necessarily to hit the Inc. 500. It's to get my business to thrive without me, to basically succeed without me having to pull all the strings in the background. And so it was a mindset shift from thinking of myself as the CEO, driver, going to hit the top line goal, to I'm a parent of my company, and I want to find a way for it to start to kind of get it on its own 2 feet without me. That's a huge mindset shift. And I think it's one that a bit of a head scratcher for a lot of people until they start to absorb it.
Yeah, I love that, and like I said, I'm so fascinated by mindset shift because I really believe that nothing truly is going to happen unless we have a mindset shift as the entrepreneurs, owners, leaders, executives at companies, and that also changes what you measure. I mean, it's interesting, like there are these vanity metrics, right? It's like the business equivalent of the old golf saying that you drive for show and putt for dough. Right. It's a similar thing, right? Top line revenue, who cares? I mean, yes, there are certain SaaS businesses that, have vanity metrics that make a difference. Like you see it, with adoption users and that kind of stuff, because they know they'll monetize later. Okay. Everybody can come up with an exception, but in general, right, most businesses, and you're right, in the entrepreneurial community. I mean, listen, EO is an example. I'm not putting them down. I love the EO community, but the measure that attests to being EO is a revenue measure,
yeah.
Right.
Yeah. Absolutely.
You need $1 million a year. YPO is the same. They have chapters that need 5, 10 million, whatever it is, but it's all top line revenue. There's reasons for that because they're not going to start measuring even in profit or whatever. It's too hard to track. So I get why those organizations do that. But I mean, you could be making $10 million at 4% margins, right? Or someone else could be at $2 million at 60% margins, right? So what is it that, you mentioned subscription, you mentioned some other stuff. So once you have that mindset shift where you're no longer, driving for show, so to speak, right?
Mm-hmm. Yeah.
What do you start tracking now that is not those vanity metrics, to now measure, this new definition of success?
Yeah. I mean, there's some qualitative things, like how many times in the day you get asked for approval to do something. So there's some like, how are my vacations? Do I feel confident when I go away? Am I having to deal with a lot of customer crises all the time? Like, those are qualitative assessments. I'm a big believer in having evaluation done once a year at a minimum, just to see how you're tracking. But really, if you think about it, the value of a company comes down to sort of two numbers. I don't mean to debase or simplify the process of valuing a company down to its core to this extent, but really it's what multiple of your profit is somebody willing to pay. And again, with SaaS companies, it's a multiple of revenue, but for the most part, it's going to be a multiple of profit. And so the two numbers are going to be your profit and the multiple someone's willing to pay. And most entrepreneurs, I think, make the mistake of obsessing over your profit. And what I would say is it's an important but not the only variable in the value of your company, because the multiple is driven by, in our experience, or what we believe, 8 unique factors about your company. And so if you focus only on your profitability, and don't ever focus on the multiple that they're applying, it's a fool's errand effectively. You want to focus on both your profitability, but also the multiple. So the drivers of the multiple are going to be things like your proportion of recurring revenue over one-time revenue, much Acquirers are going to place a much higher value on recurring revenue. Something we call the Switzerland structure, which is an overdependence on a single company, customer, employer, supplier, things like your, what we call valuation teeter-totter, but it's basically your cash flow, different than your profitability, effectively how much cash your company is generating. That's important because an acquirer is going to have to write a check for working capital. And if they don't have to write a check for working capital, they're going to be able to write a bigger check to you. However, the opposite is true. If you have to write a big check for working capital, it's going to lower the attractiveness of your business. So there's these 8 factors that drive your multiple, and that multiple is then applied to your profitability. So profitability is important, but as it's equally important, if not more, than the multiplier that it is used to arrive at a valuation. And that multiplier is driven by these 8 unique factors.
Yeah, and I love that because, in terms of, continuing the theme of mindset shift, right? I do believe like the first mindset shift people have when they learn, maybe if they get there, is okay, it's not about revenue, it's about profit, or, the deal where what we usually refer to as EBITDA, right? But I think they may get there, but so many fewer people understand this super important point that you make about what are these factors that affect the multiple? Because, right, all right, great, yeah, work on, become more profitable, that's excellent. But, if you're at 2 times EBITDA or 5 times EBITDA or 8 times EBITDA, or I'm doing deals in the financial service space now that are at 14 and 16 times, EBITDA, obviously there's a huge difference, if you're getting a 5 or you're getting a 15, right? So I do think this is an area people understand a lot less about. So talk to me a little bit about, and if you feel like sharing some of the other factors, it's great. If not, but like, how do you? Obviously, you've got the books out, you got the radio show, but but you work with companies to, basically have them have the learnings you had, right? That you were shocked into realizing in your company, your example you shared. So how do you work with folks to help them move along this journey and create more profitable and sellable companies?
Yeah. So for me, I do the podcast. That's my, main contribution to the world of entrepreneurship. But it's called Bestselling Radio, and I do a new episode every week. And we talk to an entrepreneur who's recently sold their company. My day job is I run a company called Value Builder, which is sales and marketing software for M&A professionals and other advisors that help entrepreneurs think about the value of their company. So that's my day job. That's Value Builder, and that's a SaaS company that's sales and marketing software. But really, my focus, personally, and what I kind of get excited about is the podcast. And one of the things, you talk about mindset shift, and, we were talking about mindset before. One of the things that I think entrepreneurs can do when they think about mindset shifts is remember that when I'll do a speech to a group of entrepreneurs, and I'll say, what sport most closely resembles entrepreneurship? Starting, building a business, like sporting event, right? Is it a boxing match? Is it like a NASCAR race or whatever? And the number one answer I get I'll ask you, Corey, what do you think the answer I get in terms of the sporting event that most closely resembles entrepreneurship?
That's a great question. I was thinking about it as you were talking, and I'm trying to think 2 things. What would I answer? What would most people answer? Right?
Well, what would you answer? What are you thinking?
Wow. See, the problem is I'm trying to think about a sport where you actually have to build something, where you don't just show up and play it, right? Because
friggin' lawyers, so literal.
I know. I can't. It's just because I also know what it takes to build businesses, right? And I have other ones beyond the law firm, and I'm like, wait a second, like all these other sports, somebody's created the league and the stadiums and the, and the whatever. And, so, for me, it's much more like of a, maybe like a robotics competition where you actually have to build the robot, than like football or baseball or, whatever. But I'm sure that's not the answer you get from most people.
Well, I mean, look, I agree with you. There's definitely elements to like a robotics competition. But if we push to a sporting analogy, the most common answer I get to that question is a marathon. Right?
Okay,
it's a long, slow, unglamorous, lonely slog, right? And there's a moment of glory at the very end when you cross the finish line. Everybody goes, "Woo! All right, good job." And then but there were 26.2 miles before that, which were torturous and done in relative anonymity.
Yes.
And I think that's an apt analogy for a lot of what entrepreneurship is.
Yep.
What the mindset shift I would encourage listeners who are entrepreneurs building a business to have is that while it's your marathon, when you go and sell your company, the buyer is towing the starting line of their marathon. And for them, even though you've run 26 miles and you feel like it's the longest distance you could possibly conceive of, they're about to start a race.
Yeah.
And so they need to understand what's the future of your company, right? And for so many of us as entrepreneurs, we've been so focused on our company and achieving our goal, and we're very inside ourselves, right? Thinking about our customers and our employees, and it's very insular. Yep. That we forget that really the process of selling a business is selling someone who's about to start a journey on the road ahead. What's so exciting about the journey they're about to take?
Yeah.
And that can be a really hard thing for a lot of entrepreneurs to do. It's why a lot of entrepreneurs are well served hiring an M&A professional. That's not what I do, by the way. That's not a self-serving plug. I think M&A professionals are in a good spot to have the objectivity to try to paint that picture of what's possible. Because for so many of us, we're slogging it out trying to get to 5 million, 10 million, whatever the number is in our mind that's important, right? But the idea of going to 100 million is probably foreign but for an acquirer, they have to understand how the thing goes from where you got it to the next. So I would just encourage people to remember that while it's your marathon, it's your finish line, someone else is about to start their race, and you have to paint that picture for them.
I love that picture, and it's so true. We deal with this all the time and speaking with clients, right? There's two key aspects to, I think, what you're bringing up here. One is, the seller entrepreneur, right, is always so focused about what they've created and what they put into the business. And I can't tell you how many times I have to say to my clients, in large part, an acquirer doesn't care that you worked 80 hours a week for 20 years or whatever it was, right?
That you got the customer service award 3 years ago, or that. Right. Yeah, exactly. They want to know about the future, right?
Right.
Yeah.
So they want it, right. So one point is that you're going to overvalue what you put into this thing. Right. So that because that raises another issue where a lot of entrepreneurs will overvalue the value of their business. Right. Because they're looking at what it took them to build and inputs and whatever. And the market doesn't care about that. Yes. I mean, there's some value, maybe if you've created some brand equity over that time, there's some value that goes into that. But the truth is, frankly, most businesses have not built brands that are that have independent value from the customer relationships and people and product they serve. So that's number one. And then number two is right, the point that you highlighted even more, which is going forward. I mean, think about it. If you're a seller and you're looking to get full value for what you created, well, let's say you're able to negotiate that. If the buyer can't see the upside beyond that, then why would they buy it? They're going to pay you full value for something. How are they going to make money on it, right? They got to see that ability to get it from that 5 or 10 million to 100 million. And that's why they buy it.
Or I think you're absolutely right. Ideally they see the pathway to getting your business much larger. And this happens to a lot of entrepreneurs, they think they can get your business on the cheap and that you're undervaluing it. Right. So they'll go in, and a lot of private equity companies do this, and they will wine and dine you and make you feel like the prettiest girl at the dance, and sucker you into what's called in M&A parlance a proprietary deal, where you sign a letter of intent, give up negotiating leverage with a no shop clause, and effectively fall into the arms of an acquirer without a competitive process. And they do that because they know that they can quickly add value because they can sell you for more than you're valuing yourself. Yeah. And that's another reason that I've seen this so many times that entrepreneurs, again, we spend so much time in a fairly myopic, the blinders are on, we're thinking about our business, we're focused on our customers, we're focused on our employees. And somebody from the outside, often from a big prestigious company or a sexy name, says, wow, I love what you built. Would you ever consider partnering? And it's the first time we've been validated externally for a long time. And you're like, wow, you love
think
what
I'm pretty? Oh, great.
Right, you think I'm pretty. And then they put a number on paper that's got more zeros than you've ever seen. And you're like, yeah, I'll take some of that. And you sign the no shop clause, and then they've got you, right? They often retrade, they lower the ultimate value of the deal. You never create competitive tension. The reason they're doing that is it's very intentional. They're saying, I can get this, forgive the word, ignorant entrepreneur to sell me his business or her business for 5 times EBITDA. I can flip it tomorrow for 8 times. If I add a little bit of juice to the top line, I can get 10 times. And if I scrape out, some ancillary costs and some of the stuff that, efficiencies, et cetera, I can increase the bottom line. And so it's very easy to see how they make money, preying on the naivete of entrepreneurs.
Yeah.
And so, my personal mission statement is to basically alleviate that and basically mitigate that and say, entrepreneurs, you need to become educated about how to value your business, how to create competitive tension, why you should never sign a no shop clause until you've created that competitive tension, why you need an M&A professional, like all this stuff, because I've seen it so many times that entrepreneurs leave hundreds, thousands, millions of dollars on the table because this is just not something they do every day.
Yeah, no question about it. And listen, for those listeners and viewers who are, have a little less experience, haven't been in the M&A space a lot, that's why, good investment bankers in the space, right? Deal professionals, whatever, what they're going to run a process. And when you hear that term run a process, it means that, first of all, they're going to package you up in a way that makes you most attractive, right? They're going to tease out some of the things that John's been talking about, like how do you present the company in a way that shows not only its best light on its current value, but what the future opportunity is. But then they're also going to create a competitive process, right? They're going to put it out. They're going to have people put in bids. They're going to vet. You're going to get probably several, LOIs, depending upon what it is, and then you make a decision. And then it's only when you go to LOI, right, with one of those folks, that you do give a no shop or exclusivity period, just to do it, because that's appropriate when you have chosen your number one suitor, and you now are seeing whether you can get a deal done in that period, right? They don't
You're getting
want
engaged, to use a marital analogy,
right? Yeah. So that's the appropriate time to do that. But prior to that, I 100% agree with John. And listen, I also understand it from the buyer's point of view. For example, just use an analogy. When I invest in, in any spot people invest in real estate, we're always looking for off-market deals. You don't want an on-market deal, right? You don't want one that there's a lot of bidders on, because the price is going to be higher. You want to find an off-market deal that nobody else, that's not on an MLS listing or in a broker's,
And here's one of the
buyers.
One of the hidden downsides of agreeing to an off-market deal. If you're an entrepreneur, if you're a business owner, and you say, but these guys are offering me a fair price. They're great to work with. They appreciate me. They're good guys or gals or whatever. Like you can be kind of lulled into this sort of false sense of security. Let's be clear. Corporate buyers are some of the most sophisticated business people in the world. They know how to push your buttons to make you feel important. And so it's not surprising that you feel their warm embrace. But be clear, a year after you sell your company, you'll be sitting back on a rocking chair, looking at the sunrise one morning and say, did I leave money on the table? Mm-hmm. Something will jog your thought process. You'll read something, someone will ask you a question, you'll see some other multiple that somebody got, and you'll say to yourself, oh my gosh, did I leave money on the table? Did I leave perhaps millions of dollars on the table? And that is the biggest regret. I think EPI did a study sharing that 74% of business owners have some regret a year after selling their business. And when we dug underneath that number, it was because they didn't create a competitive process. They never saw other bids. They took the first one they got, and they will forever wonder, did I leave money on the table? So even if you run a competitive process, even if you don't increase the value of your business at all through the process, which I doubt is going to happen, but even if you do, you will be able to sleep at night knowing, look, I ran a process, I got 30 companies interested, I got 6 offers, and I took the best one.
Yeah.
And I will forever know that in that moment of time, I got the best offer that was on offer at the time. Great. You can sleep at night. Yeah.
And listen, you may even, not everybody chooses to take the highest dollar offer. That's not necessarily always the best offer. but at least you knew what that was. And then you made a conscious choice to take the second or third offer because they offered, whatever it is, better pass for your employees, or you felt that they would keep your legacy in place, longer, or handle your clients better, or whatever the other factors are. But at least you got a full view of the market. And John, I want to get your input on this because I think there's another factor we haven't talked about. Because on the one hand, a lot of these acquirers who are looking for you to do an off-market deal are pumping up your ego and saying you're the prettiest girl at the dance, or guy, handsomest guy at the dance, or whatever it is, and making you feel good. But they also, very often, I think, are also creating fear as well, right? Like, sure. I mean, at the same time, they love me and I don't want to lose this deal, right? That's the other half of it. And they will subtly or not so subtly a lot of times be like, hey, listen, we got to move quickly. We're ready to whatever, and they'll make you feel often like if you run a process or bring in a banker or, God forbid, a lawyer. I mean, forget that because they always screw up deals. That you're going to risk losing this opportunity. So that's a factor I certainly see as well.
Yeah, I think you're right. And they will also sometimes amplify that by saying, not only are we not going to do the deal if we don't sort of accelerate this, but maybe we'll just compete with you.
Right.
If they're a big corporate buyer, a strategic that is in the same industry, the veiled threat is, if we don't do this deal, maybe we'll just create what you've created. So there's always that veiled threat, whether they articulate it or not. Right. It's there. And acquirers do M&A, like large companies do, sign NDAs, and they do go through the diligence process to get information. Like it is part of the way they do business. Now, I'm not suggesting that's a good or ethical way to do business, but some buyers do it not because they have a genuine desire to buy the company, but they want to understand the inside part of your business. So it can be a tricky kind of process to navigate for sure.
Yeah, that sell or be crushed, sort of implication is often out there. All right, in my experience, I mean, listen, is there some risk that you could lose that first opportunity? Yes. In my experience, the buyer, if it's a real buyer who's really going to hold, to what they've offered, and is not just trying to get information or not just trying to get you interested, and then on due diligence they're going to start shaving down their offer, they'll stay in the mix. Like if it's a real deal and they want it and they whatever, because they're big boys and girls, and they understand that if you're going to play like a big boy and girl and and do what you should do and get professionals involved, they'll generally respect that. And frankly, in my mind, if they don't, they're probably not the right partner for me.
Yeah, I mean, I agree with you 100%, Corey. I think there's a difference between having an M&A professional. Again, I reiterate, I'm not an M&A professional, so that's like I'm not saying this from a position of self-servingness, but having an M&A professional at the table to represent you does not mean you have to go run a giant process with 500 people. So some buyers will not participate in a beauty contest. They will not participate in an auction process. They will say, you, Mr. or Mrs. Entrepreneur, you have the right to run an auction, totally get it, but we're not going to participate. That's, I think, different. And there will be some buyers that do that. So part of the M&A professional's job is to downplay the number of potential acquirers they have at the table, to downplay the competitive nature of what they're doing. They're trying to, in a very artistic way, suggest that the person, you, Mr. or Mrs. Buyer, have some sort of unique or off-market access to this deal, even though there are 2 or 3 other companies that are also it's a very, very artistic dance they take you through. Because if they're too heavy-handed and say, offers are due at Monday at 9 a.m. and we're going to 300 people, unless you have the next Google, the next whatever, Facebook, Instagram, a lot of people will opt out and say, I don't want to be part of that. So there's a lot of nuance to it, but a good M&A professional is able to toe that sort of line, create competitive tension while not alienating potential acquirers. And so again, it's very difficult to do that on your own. You want somebody who has the the dexterity, the EQ to be able to navigate that conversation on your behalf. Yeah. Because if you go too heavy-handed saying, well, we're going to shop this thing to 300 people and your offers are due, a lot of people will be like, good luck, we're out. And so there's some subtlety to it.
Yeah, listen, that takes, and all of these things are a little different industry to industry, even in market, obviously it's very different if you're in a super hot market.
Versus, for sure.
Less so, so, and it's why, good professionals will help you understand, the landscape there and put you in the best position.
Let's take a break from the show for a minute so I can invite you to a new way to determine your deal readiness. I created a fast and easy assessment that will determine exactly how deal ready you are. Once you complete the assessment, I use your responses to identify the obstacles that are holding you back from being a deal-driven growth genius. It's as easy as heading to CoreyKupfer.com/assessment. That's CoreyKupfer.com/assessment and filling out a few multiple choice questions. I'll be checking in after the episode to see what your results are. Now back to the show.
John, talking about market, and obviously every industry is different, but a lot of the questions have been coming up lately of various of my clients in various industries is, of course, hey, we've had a good run here, right? There's been in many markets, there's been a huge amount of capital that's come in. Obviously, the economy has been, obviously we had a pandemic, but I think the most accurate description of what happened in the economy during the pandemic was this concept of the K economy. We had some industries that were on the downstroke, but there were plenty that were on the upstroke. I mean, we do a lot in financial services and tech, and those industries boomed, during the pandemic. So there's at least been, healthcare, logistics, a bunch of sectors that did well. And in general, it's been a good time, for deals. And there's been a lot of capital and there hasn't been a lot of headwinds, maybe pandemic aside in some industries. But now, we hear the R word, and I hate to, I hate to create self-fulfilling prophecies, like the news starts talking about recession and then everybody so I really try to avoid that. But, listen, the stock market's been volatile and down in correction territory now. Interest rates are going up, some world events and whatever. What are you seeing with all the people you talk to, all the entrepreneurs, all the M&A professionals? What's the mood out there? What are you seeing? How is it affecting deals? I won't ask you to predict the future because none of us can, but how is it starting to affect deals at all?
Yeah, I think most entrepreneurs want to time the market, right? So I think we all want to sell our business at the peak. That's what we aspire to do, right? So the peak is when our business is booming, interest rates are rock bottom, economy's booming, and we somehow magically nail that. In reality, nobody has a crystal ball, to your point. I think it's very hard to time the market. And I think it's actually a bit of a fool's errand. Yeah. Here's why. I think what an M&A professional will tell you is, and again, this varies a little bit by industry, but most industries will trade in a fairly confined range of multiples. So they'll trade, most industries will trade at 2 turns between the trough and the peak. What that means is 2 turns of multiples. So for example, if in a great economy, your business would trade at 5 times EBITDA, in a terrible recession, it might trade at 3 times EBITDA. Yeah. And so you could say, okay, well, then I've got to wait until we have a great economy and I can get 5 times EBITDA for my business. The challenge is you've got to go do something with the money. So if you sell it 5 times, the chances are that the same market conditions that allow you to go 5 times are also inflating every other asset class that you will go buy with the proceeds. So you sell your company, and what are you going to do with it? You're going to buy the stock market, you're going to buy commercial real estate, you're going to buy residential real estate, you're going to buy vacation property, you're going to buy Bitcoin, whatever. All of those asset classes are going to be inflated at exactly the same rate as your privately held business is. So you go buy the top of the market. Equally, if you sell at the trough and you only get 3 times, well, guess what? You go get to buy those assets in their trough. And we did some analysis and we looked at a company that sold at the peak of 2007, right before the Great Recession, and took the proceeds, put it in the stock market. And then another seller who sold at the near, like January 2009 when the stock market dropped below 7,000 and got the bottom of the market for her business. And of course, 10 years later, the person who sold at the bottom and put the money in the stock market has well outperformed the person who sold at the top. And again, would we all like to time the market? Of course we would. And will we all go buy something with what, some people will be smart and put them, proceeds in a money market fund for 2 years, but most of us will go buy something. Right. And as a result, I think trying to time the market is somewhat of a fool's errand. I think what you're better off doing is timing the sale of your company when you're on a winning streak, when your business is on a winning streak, when it's really not dependent on you anymore, when you've won some new business, when you've got a great pipeline, regardless of what's going on in the market. Yeah, you'll get the prevailing price for what your business is worth given the market conditions, but you'll also get to buy into those same market conditions. So I think that's the way to sort of time it when your business is on a winning streak.
Yeah, I think that's such great advice, John. And the other thing, I think I might have mentioned this recently, but it might have been October, November 2011. I did a solo cast where I'd done some research because at that point it was clear interest rates were starting to push up. The Fed had announced they were going to do a number of raises, and I look back on something that I've been doing this for 35 years, so I just felt it was true, and then I did the research, and there is no correlation. There is zero correlation between rates of deals getting done and interest rates. Okay. There have been years where there's been super high interest rate environments and there's been a huge number of deals done, not so much, same in low, right? So there's no correlation. Now, obviously, listen, some things change, deal structures change in riskier environments. Maybe there's less money up front, more on the back end. Yes, multiples, valuation change. But in terms of deal flow, which is really, really interesting, right? People, I think their automatic default would be to think that in bad economies, there are fewer deals. But in bad economies, there are more opportunities in many ways. And there's so many companies that have been super successful that have been born. In fact, there's stats that show that a lot of the great companies have actually been born during, challenging times. So, I think talking about mindset, I think some of these assumptions, about when it's appropriate to do a deal, like John was saying, is really the statistics, bear them out in various ways, whether it's John's example about, selling high and then having to buy high, or it's the lack of correlation between interest rates and deal flow. It all supports the fact that, there's always an opportunity to do a deal. It depends upon, just what type of deal and your timing. So I was just gonna
pick up on that point and just provide your listeners, entrepreneurs listening, with just another perspective on answering the question, when's the right time?
Yeah.
And another way to think about the right time is when you crest the freedom point. What's the freedom point? It's the point at which the after-tax proceeds of selling your company will create a nest egg large enough for you to live for the rest of your life and fund the lifestyle that you want for the rest of your life. And you may say, well, why is that important? I think it's important to remember because if you go back to why you started your business, I would challenge you to ask why that was. For a lot of entrepreneurs, it's because they crave freedom. Freedom is this currency that is the kind of underpinning of everything that we do, is that independence, that desire to not be beholden to someone else, to call our own shots, to decide what and when and where we want to do what we want to do. And for a lot of us, we lose that as we build our companies. They become larger and we've got responsibilities and mouths to feed and employees that are angry. And we have all these sort of things that make us feel heavy again. And I would just go back to what was the aspiration in the beginning for a lot of entrepreneurs. I'm not saying all, but for a lot of entrepreneurs, the aspiration was freedom. And when your company, by selling it, would garner enough after cash proceeds to give you the freedom to fund the lifestyle that you aspire to have, it's at least worth asking the question, is now the time? I think it's at least worth asking the question, because we have the tendency to move the goalposts, right? The yardsticks. Oh, we reached 5 million. Well, now we can reach 10. And we keep, and then we wake up when we're 75 in the hospital because we've had some sort of health event and think, oh man, the last 20 years have been a bit of a blur and I'm not sure I enjoyed them. And I think it's just worth asking, maybe now's the time, even though there is more money to get, more money on the table, more meat on the bone, maybe now. So just worth thinking about.
I love that point, John, because listen, if you've gotten to that point where the number is high enough where you never have to earn another dollar, for example, right? And you can live the life the way you want it. And by the way, I could see, an argument for it, but at least I like the way you put it. It's at least a time to look and say, hey, is this the time? Because because if all right, so maybe you could have gotten a few more million if you waited to another time, but is that really worth it? And listen, you may evaluate that and say, what it is, because above living this great lifestyle, I really listen. My wife and I just went through this process. We do it periodically, but we just recently sat down again with our financial advisor, and we gave them some scenarios. We said, hey, let's say we want to, and by the way, I don't know what my timing is or whatever, but I want to know what my options are, right?
Sure.
So I'd say, hey, let's say 5 years from now, I never want to, I'm never going to earn another penny, right? And I want to continue the lifestyle we live now. What will that take, right? And then I said, give another scenario. I want to, have a lifestyle where I've got a couple $100,000 a year more, right, than we have now, right? Because maybe I want to travel more, or for my wife and I, we want to do more
charity stuff or whatever. Right? Yeah, totally.
So we want to, and that at least gives us the opportunity. You can say, okay, if I sell my business now, I can live the lifestyle I'm living. Great. Is that good? Or do you want to hang in there because you do want to, be able to give $1 million a year to charity or whatever it is, right? But you get to make those choices, which is phenomenal.
People think wealth also is like, everybody's heard the old analogy that, improving your wealth beyond a certain point it doesn't really improve your satisfaction with life. And I think everybody's sort of heard that sentiment. I think it's around, I want to say it's around $70,000 a year. Once you get past that in terms of annual income, the incremental improvements on your lifestyle are very modest, right? In terms of your life satisfaction. Yeah. I would actually take it a step further and say it's actually more of a cliff you start dropping off. Mm-hmm. And so I would argue that there is a point of wealth that more actually diminishes your lifestyle. Like you think about Elon Musk, the world's richest person, I believe, or I can't remember if it's Bezos or Musk, but who cares? Musk is up there as one of the wealthiest people in the world. What does he have? 2 or 3 wives. He's got 5 kids. He can't move outside of his factory without being photographed by a listed paparazzi. These pictures of him shirtless in Greece jumping off a boat. He doesn't have any of the freedom that most entrepreneurs desire. Is he having a huge impact on the world? Obviously. Is he fulfilling a very important role in society? Yes. But I would argue there's actually a point where you now have to start worrying about, the safety of your kids. And do I need to get security in the house? I mean, there's all the stuff that actually starts to undermine the quality of your life. So look, I don't know when that happens, but there's a point where there's so many zeros in the bank account that it actually undermines your quality of life. So I don't think it's linear. I think there's actually a point where it starts to drop.
I agree. Listen, I've said to friends and family, whatever, like, I don't care how much money, there is no amount of money you can pay me to live that kind of life.
Right.
There isn't. There isn't, right? I tell you, whether it's stars, the celebrities, the business people, whatever, I mean, if I can't go out and if my kids are getting, if I have kids, if they were getting photographed, if I don't have any privacy, if I can't just go take a walk, all right, you can't pay me enough money to live that life, So I 100% agree. John, before I ask you my final 2 questions, one of which you previewed a bunch, which is interesting, but anything else that just comes to mind? I know, listen, you and I, because we live in this world, we could have a week-long podcast and not cover, right? The far majority of what there is to talk about in this space. So this is a pretty open-ended question. But is there anything, in particular that's either been on your mind, or that's a big piece we haven't covered, piece of advice, or interesting last story that you want to tell before I ask the last 2 questions?
No, I mean, I think we've had a pretty wide ranging discussion. And I think, Yeah, I would go back to the timing. I mean, I know it's a tumultuous time for a lot of people, and people are worried about, gas prices in Europe and heating your house. Like, there's all kinds of stuff going on, and I think that's important to listen to from time to time, but also remember that what really matters is your business, why you started it, and so I think we've covered a lot.
Love it. Okay, great. So my second last question is just give people. I mean, we mentioned some of the books in the podcast, whatever, but what's the best place for people to find out more about you? Website, links, contact, social media, whatever it is.
Yeah, just builttosell.com, and you'll find me and social and the podcast, anything like that. Builttosell.com.
Awesome, folks. And listen, definitely check out. I mean, John's got some great content out there. Whatever. Any of you who know me know I come from an abundance mentality. So, I am not like, I encourage people to listen to other podcasts. I think John's podcast, this podcast have some overlap, but the truth is we talk about all kinds of deals and just shifting the mindset and looking at different opportunities. And we do have amazing folks like John on, and investment bankers and other entrepreneurs who've sold their company that talk about some of these things around exit. But this podcast doesn't focus like John's, podcast focuses on, really delving in and being consistently talking about every week this whole conversation of how you exit and build enterprise value and finding the right buyers and do it. So, for those of you who are interested in really getting into that piece, definitely go check out John's podcast and his books and the other stuff he does. He does great stuff. So John, my final question, which is the one I said, you previewed, I always end the podcast the same way, which is my highest value in life, my highest ideal in life is freedom. And it is, for me, it means everything from freedom from all people in the world, from oppression, to why I'm an entrepreneur and I haven't had a boss for, decades. So what is, I know you talked about it generally and about, entrepreneurs and this concept of freedom, but what does freedom mean to you personally, and how does it impact your life and business?
Yeah, we did some psychographic research into entrepreneurs years ago, and we discovered there are 3 different motivational profiles of entrepreneurs. We call them mountain climbers, freedom fighters, and craftspeople. Okay. And so mountain climbers are motivated by top line revenue growth. Yep. Craftspeople motivated by mastering their craft, being the best at what they do, and freedom fighters motivated by independence. And so for me, I'm a freedom fighter. I have the aspiration to, do what I want when I want to. And sometimes that means, going to see my kids' volleyball game because I can. I was just talking to them the other night we do a little round of gratefuls around our dinner table most nights. And my grateful just last night was, I am grateful I have the flexibility to come see your games because I never have anyone to answer to other than myself, and I can always decide to go, and I do, and that's hugely important to me, and I'm grateful for that flexibility and freedom. So that's what it means to me.
Love it. John Warrillow, thanks for being such a great guest on the DealQuest podcast.
Thanks, Corey. It was fun.
Thank you for joining me on this episode of DealQuest, where we help you understand how deal-driven growth can be your ticket to freedom. I want to invite you to a unique way to tap into the wisdom and experience of the DealQuest community. Join the DealQuest Deal Den Zoom calls, a free monthly 90-minute mastermind. In the mastermind, we address all the challenges you may be facing and help support you with the opportunities that may arise in terms of deal-driven growth. You will get input not only from me, but all the members on the call will collaborate and serve each other in a mastermind format. To sign up for the free mastermind, go to www.corykupfer.com/dealden. That's corykupfer.com/dealden. I'll see you there. I'm Corey Kupfer. Until next week, wishing you the freedom and financial prosperity that I know your DealQuest will bring.